Income Tax 2020 Standard Deduction. Come in, relax with Income Tax 2021. Standard deduction. When thinking about the standard deduction, we want to consider it in context of the tax equation. So the tax equation is going to help us to visualize what the impact of the standard deduction will be on the income taxes. And when things change, then we want to have an idea what will be the change to the income tax. And the easiest way to do that is to visualize it within the context of the income tax formula. The top of the income tax formula basically be an income statement altered for basically a tax income statement. Notice we did kind of jump down here to the standard deduction instead of starting up top at income. We will go back up to income and add those items. We're starting down here in the standard deduction for a couple different reasons. One, it's going to be standardized and fairly basic, and two, it's tied to the filing status, which is at the top of the tax return. So when we first fill out the top of the tax returns, filing status, single, head of household, married, filing joint, and so on, then we're thinking in terms of the income tax equation in part of this standard deduction. That's one of the primary things we are keeping in mind. Now, also note that when we think about the equation here, we have income, then we have the adjustments to income, which you can think of as basically altering income or a deduction. They're kind of like the same thing. Like if income wasn't included or it was a deduction, they're acting in a similar fashion. And that'll give us the adjusted gross income. Then we're subtracting out the standard deduction or itemized deductions, whichever is larger. So we got kind of these two groups of deductions. One, the deductions, which are going to be the adjustments to income, which you could think of as, decreases in income, which are basically the same impact as a deduction, sometimes called above the line deductions or Schedule 1 deductions now with the change in the tax return a couple of years ago. And then we got the below the line deductions, which are taking either the standard deduction or the itemized deductions. Now, the itemized deductions are on the Schedule A, and remember, you'd have to basically compile all the itemized deductions together, see if they are going to be greater than the standard deduction. If they are, then you would have a benefit to take the itemized deductions and therefore will do so. So it's important to know kind of like the standard deduction amounts so that you can have an idea in your mind when you're talking to tax clients or when you're thinking about your taxes yourself as to whether the itemized deductions will be worth compiling or not. Are they worth looking into or not, given the fact that they would have to be greater than the standard deduction in order for them to be beneficial. Also note that a couple of years ago, there's been changes and this trend to try to simplify the tax code. To simplify the tax code, they've been trying to get people, so more people at this point in time are basically qualifying for the standard deduction, or in other words, less people at this point in time are qualifying for the itemized deductions, which would make sense if you're trying to standardize the code. Now, that could totally reverse next year, but at this point in time, that's what the trend was going towards, to simplify the code, and that would mean that more people currently, and you would want more people generally, to be on the standard deduction. So that's kind of the trend at this point. Again, that could totally change. And then we have the taxable income would be the calculation. Also note that once you have the taxable income, then you're going to calculate the tax on it. And then you've got the bottom half of our equation here not being the income statement, but being credits, and they be payments that are going to be due, payments that we made like withholdings. Don't get the credits confused with the deductions. So up here we have deductions. Down here we have credits. If you're talking about $1 of credit versus $1 of deduction, the $1 of credit will be more valuable than the $1 of deduction because it'll basically go directly to or act like a payment, as opposed to a deduction up top. If it was a $1 deduction, whether it be an above the line deduction or an adjustment to income, or a below the line deduction like an itemized deduction, because the standard deduction is standard, it is what it is, or then it'll have the standard the deduction will only have an impact based on how much the tax rate was affected. So we'll talk about credits then at a future presentation in more detail. So we're up here, standard deductions. So if we think about the Form 1040, where does that lie in the standard deductions? We're going to be down here on line 9, where it says standard deduction or itemized deduction. And so we're going to take whichever is larger because it's a deduction. Deductions are good, so we want the bigger of the two, standard or itemized. These standard deductions will be listed on the left-hand side. You can't see them real close here. We'll get into more detail of them, but just note when you're preparing taxes or doing taxes, you can actually look at the Form 1040 to consider what the impact would be if the filing status changed. because it'll give you single, married, filing joint, head of household, and so forth. This is going to be tied directly to basically the filing status. So status, which talked about earlier, single, married, filing joint, married, filing separately, head of household, and so on, will have an impact primarily on the standard deduction down here. And so that's why we're kind of thinking of them together. This is the first thing we look at the 1040. It'll have an impact on the actual tax equation down here on the standard deductions. So here's the general rule for them. Standard deductions, I would think of it this way, basically. You want to think of single first, and then think about what would happen if married, and then go from there. So if someone was single, the standard deduction, this is what I would think of as the standard deduction, would be $12,400 for 2020. So $12,400. Now that's going to be the same for married filing separately, which makes sense because now you're taking someone who would be filing one return, breaking it in two. If they go from single to married, what you would expect then is for that standard deduction to double. Because now if you had two people filing separate returns, then they would both get a deduction of $12,400. If they're both filing the same return, then we don't want a penalty for people to get married, and therefore you would think that the standard deduction would be twice what it would be if single, which it is. So married filing joint will be the $24,800. So that's the general rule that you'd want to think of. $12,400 is the standard deduction. If someone got married, then you would expect it to double, which it does, $24,800. If someone files head of household, then you would expect something to be in between there. Head of household would mean that it's a step up from single filing status. They have a dependent or something like that would typically qualify them for head of household. So I would think $12,400, that is the standard deduction. Doubling it, married filing joint, $24,800. The head of household somewhere between there, which is $18,650. You may not have this one memorized, but you can have a ballpark figure in your head so that when you're considering things like questionings of the taxpayer, why is it beneficial to be head of household versus single and whatnot, you can at least explain in general terms there and then get more specific when you do the tax return. And when people are asking whether or not something is deductible, like charitable contributions, which mainly would be on the Schedule A or medical expenses and whatnot, you want to keep these numbers roughly in your mind to think about, okay, can this person even itemize? Is it worth it? Is it worthwhile for us to be picking up, say, medical expenses? I mean, if they're over a certain amount, then yes, they are. They will be worthwhile. But if they're under a certain amount, it might be the case that they're not going to be over the standard deduction, and there's other limitations to them as well, which we'll talk about in a future presentation. And then if they're married filing separately, now you're back to basically one person per return. That would take you back to the $12,400. And then if they're filing qualified widow or widower, then they basically get the same benefit at that point in time as if married. So they're still at the married deduction, $24,800. So this is the general rule. Then you can tack on if someone is over 65 or blind. So standard deduction increases for people who are age 65 or older or blind. So if married filing joint, there's an added $1,300, single or head of household, an added $1,650. So if you're married filing joint here, you'd be adding another $1,300 to the $24,800. So then if you're doing tax returns for people who are older, like retired folks, then you kind of want to keep that in mind, of course. So you'd say, okay, and you might not have these numbers exactly in your mind, but you might think, that's around 1,500, on basically any filing status. So you might say, okay, singles, 24,400. If they're over 65 or blind, it would be about, somewhere around another 1,500 on the deduction. If it's 24,800, married filing joint, about another 1,500 or something like that. So you can kind of do the math in your mind and get an idea of what you're looking at. So again, the way I would think about it, memorize the 12,400 single, and then if someone's married, you double it. If they file married filing separate, then you're back to single, 12,400. If they're qualified widow or widower, then it's basically the married, 24,800. Head of household, somewhere in between. You think it around 18,000, 19,000, 18,650. And then you can add around another 1,500 if over 65 or blind. And the actual numbers would be 1,300 and 1,650 married filing joint versus single or head of household. Okay, if taxpayer can be claimed as a dependent by another taxpayer, the standard deduction is limited to the higher of 1,100 or the taxpayer's earned income plus 350. So if they're claimed, by somebody else and they're filing a tax return, they're not going to get the full standard deduction because the standard deduction is being taken by the other person who's filing the tax return. Presumably, they wouldn't have a whole lot of income because they're qualifying as a dependent, typically in that case. And therefore, you have a limited standard deduction of 1,100 or the taxpayer's earned income plus 350.